Hi, this is Stephen from Share Navigator, and this presentation is part of our support night from September the 17th. It's on Google. So let's get through some of the stuff on Google. First things to note, there's actually two ticker symbols. It's floated on the NASDAQ, and the first ticker symbol is GOOG, and the second one is GOOGL. So what's the difference? The difference between Goog, it's a Class A share, which means that you're going to have voting rights, whereas GOOGL is a Class C share with no voting rights. And just so you know, where did the Class B shares go? Well, they're the founders, the original founders of the company of Class B shares, and they have the majority voting rights in the company. The size of the company, or the market cap, is 437 billion. I think it's the second or the third largest company floated on the stock market at the moment. The dividend, it doesn't pay a dividend, so for those of you looking for dividends, it's not a good stock to invest into. The share price at the time of doing this presentation was $635, and our 12 to 18 month target price is actually $700 in the stock. So the upside potential is 10%. Now, normally we wouldn't be interested in stocks with only a 10% upside in terms of a value play, but we're actually going to do an option strategy on this, and that's going to be done in a separate video. So look out for that one. We'll post that onto our website. The other thing you need to know here, the historical sales and earnings are excellent. It's traded on the NASDAQ and it's an optionable stock. So let's move on. So what do Google do? Well, in a nutshell, they're an advertising company in one sense. That's where they're making 90% of all their sales from Google AdWords. So for example, Share Navigator, we're a small to medium-sized company. We advertise our business on Google. And if somebody, for example, searches for stock market training, Share Navigator will pop up. If they click on our ad, then Google get a fee from us. There's another aspect to this as well called AdSense. That's where companies allow ads to be displayed on their website. And again, Google get a kickback from that, as well as the company which allow it on the website there as well. They get some income as well from Google Play Store, which is, you know, if you use Apple products, you know of iTunes. Well, the Google Play Store is the equivalent of iTunes, where you can get your apps and music and other bits and pieces as well. Now, they also heavily invest in other projects, and this has been a bone of contention for institutional investors for a while. I'm not going to get into what these projects are. Fiber, for example, is the high-speed broadband that they're going to bring across the globe. But you know, the self-driving car and other projects, they've invested heavily in those. And the reason the investment community weren't happy, it was because Google report their earnings all at once, and they didn't disseminate, you know, how much money is being sunk into these businesses, how much is it actually eating into the profits of their core business where they're making 90% of their revenues. So what they've actually gone and done is announced a new reporting structure, and they've created a holding company called Alphabet. And Alphabet will contain Google as a core business, and then it will contain other ventures as a core business. So from now on, when you actually hear Google's announced their earnings, they're going to have clear revenue and profit guidelines from each particular business, whereas before they used to group it all as one. And that actually has been received very well by the market. So when this all happens, guys, all that's going to happen is Google shares will be exchanged one for Alphabet. Nothing really changes. It's just really how they're going to report their profits and sales. Okay? So let's have a look at the finances. And what we like to do when we're looking for value stocks is see a track record of the past that management can deliver. That's all we're doing here. So you can see here the sales from 2010 for Google grew from 29 billion right up to 66 billion. And every single year we've had sales growth. And the exact same can be said for earnings per share or profits. They've grown from $13 per share right up to $20 per share. As I said, the company doesn't pay a dividend. Profit margins are stable, although they've dropped from 2010 levels of 29% to 22%. And a lot of that can be, I suppose, put on the fact that Google are investing so heavily into other areas. Their long-term debt is about 3 billion, nothing to be worried about with a company that's worth over 400 billion. And the stock tends to trade in the mid-20s in terms of a PE ratio. And we're going to talk a little bit more later on about that. So what's the technical outlook? This is a 1 year chart, and it's a 50-day moving average, which is what Google is tracking at the moment. So you can see here there was a big gap up from 580 right up to nearly $660. That was their last earnings report, and it was a blowout earnings report. Everything was fantastic in it. Everything that Google said, their profit outlook, their sales outlook was all raised. They exceeded expectations, and of course the announcement of Alphabet came as well. So all of that was very positive. Then of course we had all the issues in China, caused a massive correction in the stock and in the stock market in general, and now we're tracking back up. So what's the outlook? And this is really important. So when you're looking at stocks, it's really important to have a three-phased approach to researching them. The first one is looking at the past. So we've done that through the financials. We've said, okay, we're satisfied that this company knows how to run itself. But that means nothing about the future. The stock market is really focused on future growth. So we need to see estimates going forward of positive growth. And on the sales side for 2016, Google is forecasted to grow from 74 billion in sales to 85 billion in sales. Now that's a 15% growth rate in terms of sales. On the profit side, they're looking at growing from earnings per share from 28.88 to 33.74, which is a 16.8% growth rate. So that's very positive on two aspects. It's very strong profit growth. When you think of the size of Google, it's worth over $400 billion. To be able to grow their profits by 16% is really an incredible achievement. But what's even more impressive, their profits are growing faster than their sales. And that's one thing as an investor you want to see. So now with Google, we've satisfied ourselves on two fronts. The past looks good, the future looks good, but is the stock valued accordingly? If it's all priced into the stock, there's no point in investing. So what we've got to look now is get the target share price for Google. And as we know, our share price formula is the earnings per share multiplied by the PE ratio. So our estimated earnings per share we know is 33.74. We're going to use a low-end PE. We're going to assume things slow down in Google and it trades at a lower multiple of earnings. And we're only going to use 21. But we know from the previous slides that it can trade up as high as 30 times earnings. So 33.74 multiplied by 21 gives you a target price of 708.54. So our upside potential is about 11.4% on this. So I'm going to get in now to a little bit more explanation about earnings per share and PE. So what is earnings per share? Earnings per share is quite simply another term for profit per share. It's equal to the total profit divided by the shares outstanding. That's what it's equal to. Total profits divided by the shares outstanding. So just see it as basically as a demonstration of how much profit is being made for each share of stock. That's all earnings per share is. Now, when you're looking at earnings per share growth, you need to look and consider three different things. The first one is top line growth. Top line growth is the demand for the product itself. So you can see with Google, sales are increasing year on year, so top line growth is strong. The second one, but it's not as effective as the first one, is cost cutting. This is where, there may be layoffs, they may find efficiency somewhere in the business, and that can increase profits as well. And then the third one is financial engineering, and that's usually down to share repurchase programs. So if you think about it, if a company says, we're going to use our cash to start buying back our own shares, in essence, we're removing the amount of shareholders out there, which increases the earnings per share. So in terms of interpreting this, you'd like to see top line growth all the time. That's one thing you want to see. But in terms of the other two, they're also very beneficial to a company. But if these two are going without the top one, then you may want to reconsider it. And Hewlett Packard at the moment is a classic example. Sales are dropping, but their profit forecasts are going up. That's because they're doing a massive cost cutting program and they're initiating a financial engineering scheme as well. So just be aware of those things. On the PE side, PE stands for price to earnings ratio. Just think about it as an investor sentiment ratio. That's all it is. So as the share price goes up, a PE ratio will go up, and as the share price goes down, a PE ratio will go down. So how do you interpret PE? Well, PE, if you think about it, may indicate value if it's trading at a lower end compared to competitors. So if you look down here, we'll look at two different factors. First one is a high PE stock with low growth forecasts may be overvalued. And then secondly, a low PE stock with high growth forecasts may be undervalued. But how do we know? Well, it's really, in isolation, it's not really great. You really need to look at historical averages, which is what we've done, but you also need to look at competitors. So for Google, for example, Yahoo is one of their closest competitors. Yahoo at the moment is trading at 46 times earnings, but they don't have the same growth prospects as Google. So that would indicate to me that there's probably more upside potential in Google, because Google are trading at a lower multiple of earnings than their competitors, and they have better growth rates. So very important to learn how to interpret PE. So different ways to invest into Google. Well, if you buy the shares of Google, they are expensive shares in terms of price of them, $635. You're not getting paid a dividend. So for me, it doesn't make any sense to buy the shares. But if you want to do that and you don't have time to do options, that's fine. You could buy the call options. That's another strategy you can use. Still think it's a bit expensive with Google, so I wouldn't do that. My favorite strategy, because I have a sizable account, is selling put options on it. But I appreciate not everybody listening to this will have that size of an account. So the two strategies I would like for this, for smaller accounts, are placing a bull call spread, which is a debit spread, or a bull put spread, which is a credit spread. Now, the difference between a debit and a credit spread is a debit spread you get paid up front for placing the trade, or sorry, you pay out up front for placing the trade, and on a credit spread you actually get paid up front. So what we've actually gone and done is done some real live examples in our support night on a bull call spread, and we're actually going to place one of those trades today on Google. So I'm going to do that in a separate video which will be linked to this. Okay. So if you're interested in learning more about options, or indeed just analysing stocks, you can look at our mentoring program one-to-one. Give us a call, we can have a chat with you and talk you through the process. Okay, this is Stephen with an alert on Google. We'll be placing a second video to this, which will focus in on the bull call spread for Google. Thanks and bye for now.